Hey everyone, Chaps here, and today I want to talk about the Boglehead methodology. 2022 was a huge year for me financially. It was my first time filing jointly, and taxes really hit us hard. When I was looking into everything, I saw that our gains were decent on our investments, but taxes were really killing us. So I explored the finance space a little bit, and I kept seeing these things pointing to something called Bogleheads. I'm like, what is that? So eventually I caved and I clicked on it. I typically avoid those things with the funny names, as it seems like some get-rich-quick scheme or just some weird BS. That said, after I actually started reading about Bogleheads, I realized that it's practically what I've been doing all along already, just a little bit more formalized. So what is it? I guess I'll start by saying that Bogleheads is named after the founder of Vanguard, John Bogle, who believed very strongly in the power of low-cost index funds. And that's really what Bogleheads is all about, using low-cost index funds. We'll get into more of the details in a bit, but first let's start with a story. So in 2008, Warren Buffett issued a challenge, which Protégé Partners LLC accepted, and the wager was that he could invest and sit idle while they took 5 hedge funds and they went off and they would try to beat him over the course of 10 years. Early on, the hedge funds selected by Protégé Partners were winning. This quickly turned around, and by the time 2017 came around, Protégé had conceded defeat. In the end, the hedge funds had a wide range of returns from an abysmal 2.9% all the way up to 62.8%, which when all of that was combined, it netted a 22% profit to Protégé Partners. Buffett, on the other hand, had an 85.4% profit. How did he do so well? He simply invested in Vanguard's low-cost S&P 500 index fund. So why did this happen? Well, hedge funds try to seek short-term opportunities. They're constantly buying and selling and trying to come out ahead, and many of them do. But also, a lot of them fall short of this. The S&P 500 index, for example, will ignore all that short-term noise and focus more on the long run. They get 8 to 10% on average, and that's plenty of growth. It's not going to be the highest. There's going to be hedge funds that beat that every year, but there's also going to be a lot of hedge funds that don't beat that. Using this index fund makes you sort of go at that market average. You're just reducing the risk and getting a fairly reasonable return on investment. Getting past the rate of returns, though, what other benefits do we see with these low-cost index funds? Well, the big one's right there in the name, and that's lower fees. Many index funds have extremely low expense ratios, like the Vanguard S&P 500 Index ETF, VOO, has a 0.03 expense ratio. Fidelity's S&P Mutual Fund that basically mirrors that one is FXAIX and has only 0.015%. And Fidelity also has their Large Cap Zero Fund, which actually has 0 fees. Stepping back up another level, you also have the opportunity for lower management fees. In fact, you could even eliminate managed fees altogether by self-managing. It still may be nice to have a financial advisor, but having someone manage your assets becomes much less important as you start relying more on index funds. You're not actively buying and selling, so it becomes rather hands-off. And that brings us to the other big perk, free time. Investments are supposed to be long-term. You shouldn't be concerning yourself over the day-to-day performance. Knowing that you're just tracking the average in a low-risk option, as well as being hands-off in the approach, should lead to more free time. You'll have that peace of mind to forget about investments and use your time and energy towards things that you find more meaningful in life. All of that kind of explains the benefit of index funds. But what sort of asset allocation is recommended? I'm not going to sit here and give you specifics on what funds I think you should go into or what the balance should be. But what I will do is point you towards the 3-fund portfolio, or maybe even the 2-fund portfolio. So what does that mean? Well, really it's as simple as it sounds. Rather than having a ton of different bonds and stocks, you simplify your portfolio down into 2 or 3 index funds, or at least you do that for a large part of your portfolio. The 3 fund categories you'd be looking at are domestic stock, international stock, and bonds. For domestic stock, this should simply be invested in a US total stock market index fund. It's something that covers the full range of small cap to large cap in a variety of sectors. Some people opt to do just large cap, and that's probably fine as well, but total market seems to be the better option. International stock should be simply invested in a total international market index fund. Again, a fairly broad fund that covers the non-US companies. And lastly, for bonds, as you can probably guess, this goes towards a total bond market fund consisting of a variety of bonds. Of course, this can vary a bit, but this is the most basic example. But back to that question about asset allocation. How much do we put in each? I can't tell you the perfect number for your risk level, but I'd suggest sticking within the bounds of what is stated in our previous video. Bonds should be somewhere between your age, or your age minus 20, and stock should be somewhere between 100 minus your age or 120 minus your age. This kind of gives a range for bonds, but what about stocks where it's split between international and domestic? I said I'm not going to give exact ranges, but what I will do is this. I've been showing the Boglehead website here. It's linked down below, and it has a couple different examples of asset allocation, as well as a nice list of various recommended funds for a variety of brokerages. What I will say here is that the international portion is usually pretty small compared to the domestic portion. In fact, there's actually a lot of people who use a two-fund portfolio where they just cut international out together. Another two-fund portfolio could be something where you just combine all of the stock into a world index fund rather than splitting domestic and international. Okay, so maybe you decided this Boglehead approach seems reasonable to you, so you pick an asset allocation and you pick some funds and you invest. What do you do now? Well, it's rather hands-off. You can ignore most of the day-to-day, ignore the noise, and let it ride. Don't be fazed by the trends. That said, it's not 100% hands-off. You still need to contribute each year, and that's actually a great time to help rebalance your assets. You picked an asset allocation early on based on your desired risk level. As time goes on, this risk level will change. In addition, stocks will likely be outpacing bonds, which will throw off your percentages. Because of this, the occasional rebalance is needed. Like I said, adding money to the account is certainly a good time to rebalance the portfolio. That likely won't be enough, though. Occasionally, you'll need to pull from one bucket and put it in the other. You can set your own schedule for this, but typically it's recommended to rebalance once a year or when you see things shift more than about 5% away from your target. And there you have it, the basics of the Boglehead Three-fund Portfolio. This is actually something that I've adopted myself for many years now without even knowing about it. And now that I know about Bogleheads, I can read up, become more educated in it, and maybe even make slight tweaks to be more efficient in the way that I manage my investments. I feel like this is kind of the pinnacle of self-managing your investments. It may not necessarily be the best option, but honestly, maybe it is in the long run. But what I do feel confident in is that this is probably the best combination of strong returns with low cost and minimal effort. If you have any questions, I highly recommend checking out that Boglehead website that I have linked down below, as well as the Reddit page, which is extremely helpful. If you want to reach out to me on Twitter or leave a comment down below, I'll try to answer as many questions as I can. If you enjoyed this or you found it helpful, a like would be super appreciated. Go ahead and subscribe so that you don't miss future content. Thanks for watching, everyone, and I'll catch you next time. See ya.